What's up, everyone? Welcome to the channel. Today, we're breaking down one of the biggest stories shaking the entertainment and streaming world right now. Netflix is sliding. Warner Bros. Discovery is at the center of a bidding war, and investors are trying to figure out whether this is a rare buying opportunity or a warning sign. We'll walk through what's actually happening behind the scenes, how the competing acquisition offers could reshape the entire industry, and what the numbers say about Netflix's real value going forward. Let's get into it. The past few weeks have been unusually turbulent for Netflix, and the stock slide has left many investors trying to figure out whether they're witnessing a short-term overreaction or the early stages of a deeper re-rating. Today, we're unpacking the full story behind the recent volatility, including a breakdown of the competing acquisition bids for Warner Bros. Discovery, an event that has essentially frozen the deal process and injected uncertainty into the entire streaming landscape. And this isn't just any media deal. The buyer that wins gains access to some of the most valuable entertainment franchises in the world, from Harry Potter to Game of Thrones to Friends and more. These are assets that can reshape subscriber growth, pricing power, and long-term competitive positioning. Alongside that, we'll walk through Netflix's financial strength, its recent operating performance, and our own independent valuation built through a discounted cash flow model so you can see whether the recent sell-off is signaling a potential opportunity or a sign to stay cautious. Even with the recent decline, Netflix remains one of the best-performing media companies of the last decade, up more than 700% over 10 years. Yet the shorter-term picture tells a different story. During the past month, the trend has been decisively negative, pulling shares closer to the low end of their 52-week range and raising questions about whether the stock has stretched too far, too fast. Analyst sentiment reflects this tug-of-war. Some firms, like UBS, continue to argue the company is meaningfully undervalued and maintain aggressive price targets that imply large upside. Others have become more hesitant, trimming targets or calling the stock fairly priced after its multi-year mega rally. The divergence comes down to differing views on future subscriber expansion, the sustainability of margin improvement, and the implications of the Warner Bros. Situation. To understand why this deal has become such a lightning rod for debate, you need to look at the two drastically different offers on the table. Paramount is pushing an all-cash bid worth around $18 billion, roughly $30 per share, to acquire the entirety of Warner Bros. Discovery, including the traditional cable networks and CNN. The proposal is straightforward, clean, and designed to close quickly. Netflix, meanwhile, isn't trying to buy the whole business. Their bid targets only the studio assets and the Max streaming service, intentionally excluding the declining legacy TV networks. Netflix's offer also mixes cash with stock and reflects a fundamentally different vision for the future of the combined entity. Paramount wants to double down on theatrical releases and has committed to bringing over 24 films per year to cinemas. Netflix, on the other hand, operates with a strategy centered around streaming-first distribution, with theatrical windows used selectively rather than as the core business model. This video is for educational and informational purposes only. Nothing in this video is financial advice, investment advice, or a recommendation to buy or sell any security. Always do your own research and talk to a qualified professional before making any financial decisions. Both proposals face meaningful obstacles. Regulators are already signaling that a Netflix acquisition would undergo intense scrutiny because Netflix controls an estimated 40% of the U.S. streaming market. Concerns revolve around content concentration, competitive fairness, and whether a vertically integrated streaming giant would reduce consumer choice. Added to that is a hefty breakup fee. Warner Bros. Discovery would owe Netflix nearly $3 billion if it accepts the Paramount offer. This makes Netflix's bid more complicated because if they try to raise their offer to match Paramount's terms, they assume additional financial risk on top of potential regulatory delays. Meanwhile, the Paramount bid, although cleaner, has become controversial because of the political connections involved. The deal includes participation from Jared Kushner through his investment firm and David Ellison, who has openly discussed his family's relationship with former President Donald Trump. Trump himself has commented on the situation, implying he may involve himself in the outcome. For investors, these political ties weave in a new layer of unpredictability. While the acquisition drama captures the headlines, it is equally important to zoom out and look at the fundamentals of Warner Bros. Discovery, the asset everyone is fighting for. Recent financial results reveal a company with solid revenue diversification across studios, networks, and streaming, yet also clearly struggling in key areas. Legacy cable networks continue to shrink by double-digit percentages, and average revenue per user on the streaming side has slipped both year-over-year and quarter-over-quarter. The company remains weighed down by a massive debt load of more than $30 billion, far exceeding its cash reserves, and it has posted sizable losses in recent years, despite occasional strength in the film division. These weaknesses help explain why potential acquirers are focused primarily on the studio assets and streaming rather than the full business. At the same time, the iconic franchises housed under Warner Bros. Offer unique, irreplaceable value, content that can supercharge subscriber growth and justify premium pricing for any platform that controls them. Netflix, by contrast, enters this situation from a position of relative strength. The company continues delivering double-digit revenue growth, with Asia-Pacific leading expansion. Profitability has improved dramatically compared to 5 years ago, as management shifted from a growth-at-all-costs model to one prioritizing disciplined spending and margin expansion. Gross margins, operating margins, and free cash flow generation have all set new company records. Operating cash flow is nearing $10 billion annually, and return on invested capital has climbed above 20%, signaling that Netflix's reinvestment strategy is efficient and value-adding. Even so, institutions have started to show signs of hesitation. Over the past quarter, institutional investors were net sellers of Netflix shares for one of the few times in the last several years. Some well-known investment firms added positions, while others trimmed exposure. Members of Congress were also buyers late last year, though those trades are now dated and don't fully reflect sentiment during the current volatility. Evaluating whether Netflix is a high-quality investment requires balancing the undeniable strengths: dominant market share, strong margins, consistent free cash flow growth, with valuation realities. Netflix trades at a significant premium to the media sector on most traditional metrics. Its forward PE is more than double the industry average, and while its P/HEG ratio is more reasonable on a historical basis, it still reflects a premium investor confidence in sustained growth. Compared against peers like Disney, Spotify, Warner Bros., and others, Netflix has been one of the weaker performers in the most recent 12-month period. Yet over 5- and 10-year windows, it remains one of the clear winners, reflecting its long-term ability to differentiate itself through original content, global scale, and platform efficiency. Financial statements paint a clear picture of a company that has transformed itself over the last decade. Revenue has exploded from under $7 billion to more than $40 billion, and net income has expanded consistently with only brief interruptions. The balance sheet, while still carrying more debt than cash, is far healthier than it was years ago. Debt levels have steadied, and the company's ability to generate cash allows it to reduce leverage over time. Share count has stayed essentially flat, avoiding the dilution that many other tech-driven media companies have used to fuel growth. With margins, cash flow, and ROIC all trending upward, Netflix's core business model looks stronger today than at any point in its history. To bring all of this into perspective, we built a discounted cash flow valuation to estimate fair value under different growth assumptions. Using moderately optimistic revenue growth of about 15%, consistent with analyst expectations, our model produced a fair value estimate around $83 per share. More conservative assumptions point to potential downside, while more aggressive scenarios show upside if the company is able to accelerate earnings growth or improve margins further. A reverse DCF analysis reveals that buying at roughly $96 per share implies long-term revenue growth expectations of about 17% annually. For investors who believe Netflix can outperform those expectations, the stock may appear undervalued. For those who believe future growth will slow, the current price could embed too much optimism. The market's reaction to the Warner Bros. Situation highlights a deeper concern. Netflix's growth path has become more dependent on strategic decisions rather than purely organic expansion. Acquiring major franchises and integrating a rival studio could transform Netflix into an even more dominant media powerhouse, but it also exposes the company to antitrust risk, political tension, and the financial weight of a potentially larger purchase price. If Netflix is forced to raise its bid to compete with Paramount's offer, the economics become less attractive. If the company walks away, it risks ceding some of the most valuable storytelling universes in the world to a competitor. And with regulatory pressure mounting in the broader tech industry, no major entertainment deal is guaranteed to proceed smoothly. All right, that's going to wrap up today's breakdown. If you found this helpful or learned something new, make sure to hit that like button, subscribe, and turn on notifications so you don't miss future uploads. And let me know in the comments what you think about the Netflix Warner Bros. Situation. Is this a long-term opportunity or a major red flag? Thanks for watching, and I'll see you in the next one.